Gentlemen, it's a great pleasure to see you here for the Q4 2021 Advisory Board meeting. It's a great pleasure having Jim Ricketts, our regular member of the Advisory Board here. Jim, good to see you.
Good to see you, Ronnie.
You're currently in Montreal with the
Montreal, a
family.
little more international, yep.
Then we've got our special guest, Kevin Muir.
Thanks for having me. I'm looking forward to this, guys.
You are based in Toronto now.
Yeah, we got two Canadians. Half the call's Canadian today.
So somebody on Twitter said we should talk about beer, and I think what was it? Favorite Labatt Blue vintage. I didn't really
That's
get
blue. That's like Canadian beer, and it's kind of the trashy beer, the
Okay.
kind of not that great beer.
You know what beer I drink in Canada?
What's that?
Rickards.
There you go. Yes, that's right.
It's one of the most popular brands, and they do not export to the United States, so I can only get it when I'm up here. But there's Rickards Red, Rickards Dark, and Rickards Pale, and yeah, you can get it all over, and it's good beer.
That's great.
So Kevin, thanks for taking the time. And Mark, my dear colleague, currently in Liechtenstein in our office. Mark, good to see you.
Grüezi from Liechtenstein, as they would say here.
Grüezi wohl. So yeah, let's start with a brief introduction of our special star guest, Kevin Muir. I will read his brief biography. Long passionate about markets, Kevin grew up in a household where his father was an equity research director. Being exposed to market talk as long as he can remember, Kevin's true love always was macro. In fact, his first trade was in the US dollar index, which promptly went limit locked against him. Not deterred, Kevin got a job at an institutional equity desk for a big Canadian bank in the 1990s. He moved on into a proprietary group where he was in charge of the equity derivatives book. Kevin had a ringside seat for the madness of the dot-com bubble, but in 2000, with a new young family and the desire to not longer work for a bank, I think that's a feeling that we all know pretty well here. Kevin set off on his own. For the next 17 years, Kevin would trade his own account with another former co-worker and a full-time computer programmer student they hired. Since then, Kevin has joined a well-established prop group. Kevin, again, thanks for taking the time. We are very, very happy subscribers to your Macro Tourist newsletter. We actually missed you in August because you took a month off, and for us it was pretty hard. And since then, you've been extremely productive again. So just to quote the last couple of posts that you've made, changing the equation, the tourist examines the debt ceiling debate through a market lens, then Powell is done and what it might mean for markets. Then you wrote about the option whale that changes shape. You wrote about the hawkish shift. So the latest FOMC meeting that represented a dramatic change in attitude at the Fed, the Evergrande hyperbole, why it's not as bad as it seems, and some names to maybe buy. And you wrote about three things working against the market. So, I mean, there's so many topics to discuss today, and we all truly look forward to our conversation. But first of all, I have to say something pretty sad. Heinz Blasnik, who was a regular member of our advisory board, he was a very, very good old friend and also a mentor of ours. He co-authored a book together with us, and he helped us tremendously with the Ingolby Trust report. He passed away, unfortunately, a few days ago after long and very painful illness. And yeah, the funeral is gonna be in 2 weeks, and it's a very, very sad news that we got. Yeah, rest in peace, my friend.
Sorry for your loss.
Thanks. Yeah, I mean, after such news, many things seem quite pointless and irrelevant, but still, I want to say what Mark and I have done over the last quarter. Well, I was on the road again. I did my first big keynote in person after almost 2 years. I did a presentation at the Precious Metal Summit in Colorado, talking about the monetary tipping point. I also attended the Denver Gold Show, met with more than 80 companies from the mining space. And yeah, was good to see so many good old friends in person again to talk to mining companies. We found some very interesting new companies. We talked to all the big guys in the industry, and it seems that the gold mining industry is really at its best shape, while probably the sentiment is at its worst. Then we also just published our In Gold We Trust chart book. We will do the Oktoberfest special for all lovers of beer, gold, and the preservation of purchasing power. So this will be published very soon. At Incrementum, we did a redesign of our webpage. Have a look at it. I think it's pretty neat. The last advisory board call was with our dear friend and partner Christian Scherer, who manages our uranium fund. Since then, I think when we had the call, uranium spot was trading at 30. Now we're above $40 per pound, and it seems that, at least to us, uranium is still very much undervalued. So that was, I think, the timing couldn't have been better. And yeah, besides that, we are currently already working on the Chinese edition of our 2021 In Gold We Trust report. So this is what's going on our side. As mentioned, we're still pretty much sad about the big loss. I think everybody who knows us knows how much we enjoyed reading the Acting Man blog that Heinz Blasnik wrote for many years. So all the best to his family, and again, rest in peace, Heinz. Mark, do you want to start? You're still muted.
Sorry.
Yes.
I'd love to start. Thanks, Ronnie, for the introduction. Okay, I mean, let's just dive in. I think we have the macro tourist here, and Jim Rick is also very astute in macro topics. So I'd like to kick this off by starting to talk about perhaps gold and perhaps in the broader sense the inflation debate. So I think to some degree we can recapitulate 2020. We perhaps debated inflation or deflation. I think 2021, the debate rather is, will it be inflation transitory or will it be persistent? So, and together with this debate, I think very relevant, obviously also for us, the question is what's happening to the gold price. We have a few thoughts, obviously, on that. So the gold price, I think one can say, has disappointed to some extent because probably the main factor, negative real interest rates, they have become even more negative. So that would probably, one would assume that this is a good environment for gold, but it really didn't take off. It's stagnating, perhaps even falling a little bit during the last months. So I'd love to pick your brains on that one. Where I just may add a few thoughts already in advance. I think one of the potential explanations is that the current narrative in the inflation debate, namely that inflation will be transitory, seems still to be the prevailing one, or the one which the main market participants still adhere to. We saw a few indications in this regard. For instance, I recently retweeted a tweet from the IMF, which posted there inflation expectation, basically 2022, it already is coming back nice and neatly to the 2%. And I think same is currently still represented in the tips. So that would be indication for me that this transitory narrative is still prevailing. Yeah, let's start with our special guest, Kevin. Could you share your thoughts?
Sure. So I think that a lot of people have been confused about why gold has not performed better. It seems like the perfect environment. We're running big deficits. We're having low negative real interest rates. I think that it can come down to a few factors. One of them, no doubt, is the fact that Bitcoin has pulled in a lot of the people that would have traditionally gone to gold as a safe haven. So I think you just have to admit that and understand that and just accept it. And you can decide what you want about Bitcoin over the long run, whether it's going to work and whether it's going to be a true competitor to gold. Well, that's another kind of topic for discussion. But there's no doubt that some of the money was pulled in that would have traditionally gone into gold as that. But if we look back, I think that we should examine the gold rally of the past 2 years and think about what happened. We had COVID. COVID initially caused a dramatic rise in real rates because the bonds went no bid and there was all sorts of worries about deflation. And then very quickly, the Fed stepped in and there was all sorts of liquidity. And not only that, the fiscal pumps were, opened up wide, and we had a dramatic lowering of real rates. And if you go look at the 10-year had been trading the 10-year real tips, meaning the real yield. Before COVID, had been trading at zero, like even. It spiked to 50 basis points, at which point the Fed panicked, said, whoa, we can't have that. We had an immediate kind of decline back to zero, a walk down to minus 50 basis points. This is at the 10-year level. And then from March to August, we had a move all the way down to minus 100 basis points in the 10-year tip yield. So we were at minus 100 basis points. And I remember that August very well, because at that point, that was when there was all sorts of excitement in the gold market. People were just storming in. You couldn't be bullish enough. We had Warren Buffett announced that for the first time ever that he had bought some Barrick, whether that was him or one of his lieutenants, who knows. But we had Warren Buffett doing that. We had Ross Gerber, who's like a technology PM from Silicon Valley or from LA or something, like a complete guy that never trades gold. He's proclaimed that it was the easiest trade in a long time. And whenever I saw that I wrote a piece at the time and I said, this is crazy, because when you get somebody telling you that something's so easy, I just know markets and I know that means that the sentiment is so lopsided against it that you should be going the other way. And I actually, even though I had been a big gold bull, I wrote this piece and I wrote this piece saying it's time to take some money chips off the table. And I likened it to, being a Canadian, we compare everything to hockey, and one of the greatest hockey players that's ever lived is Bobby Orr. Bobby Orr used to skate around everyone, and everyone was kind of in awe of him and didn't want to do anything, go check him or whatever. And then one of the opposing coaches screamed out, "He's not God, hit him." And I remember thinking that when Warren Buffett announced that he was buying Barrick, I said, he's not God, fade him. And since then, that proved to be the high within a month or maybe even a couple of weeks. We've been straight down since then. And interestingly enough, that was at the point that you saw Bitcoin really take over the narrative. And you saw Bitcoin actually get a bid, and it's outperformed since then. Now, one of the things that we have to realize is the 10-year tips yields are still minus 90 basis points. So we haven't actually gotten that much more negative. And then the other thing that I think that people are missing on the gold story is the central bank purchases. And if you look at going into the COVID point, there was all sorts of central bank purchases. They were buying 200 metric tons a quarter. It was like one after another, after another, after another. And they were driving a lot of this kind of bull market in gold. Well, then what happened was COVID hit. The first quarter after COVID, I think we went down to 20 metric tons. And then for the first time in a decade, the central banks turned into sellers. And we actually had, I think it was the second or the third quarter of 2020, they became sellers. And so when I look at this, if we get the central banks that used to be buying and they're turning into sellers, there's all of a sudden a lot more. So to me, I look at gold and I look at the kind of disappointing year that we've had, and it doesn't fuss me that much because I just view this as we got way ahead of our skis. Everyone got bulled up on it. There's too many longs in the market. Central banks walked away, and now everyone hates it. Everyone, Ronnie was telling me the story about being at the Denver Gold Show and how there's empty, presentation rooms, like literally 10 people there. Well, to me, I look at that and I say, do I want to buy the asset that's cheap and that nobody cares about, or do I want to go chase the thing that everyone else is chasing? And to me, it's very clear. I think that you should be buying gold down here. I think that over the long run, we have shifted from a monetary, an environment of monetary dominance to fiscal dominance, which will mean that inflation is going higher. Gold will be one of the few things that saves you. Yes, there are transitory elements of this inflation story, but make no mistake, underneath the kind of the wiggles of inflation is a change in move from something where 2% used to be a ceiling, and I think it's going to become a floor on the inflation front. And when I look at it, it just gold has a place in your portfolio.
Thanks, Kevin. Well, actually, for me, a very interesting moment was at this conference, and I talked about it in a Kitco interview. Was when I was talking to I would say a die-hard gold bug at the Precious Metal Summit in Beaver Creek, and I said, well, I actually could imagine gold going to new all-time high in a couple of months, because now we're trading at 1760, and actually gold's all-time highs are not that far away.
Right.
And he said, no, that's impossible. Gold is dead. And if somebody who's really into it, has lost all the confidence and all the optimism and just throws in the towel, I think that says quite a lot.
Can I interrupt there 1 second, Ronnie? Can I interrupt with just a famous saying that Don Cox has? Don Cox, a famous strategist for Bank of Montreal, used to say, those who love it least hate it the most because they've been burned the worst.
Yeah.
And that's when you want to be buying it.
Absolutely. Now, Jim, I think that one of the also important drivers for gold, I just had a look at ETF demand, which is, from my point of view, I think ETFs are quite important to gauge interest from institutional investors, and actually there were outflows in the last quarter, and we all know that they are very, very pro-cyclical. So ETF demand goes up as soon as the price of gold goes up, and vice versa. So Jim, from your point of view, what should happen that gold will win back its mojo and actually trade high again? From your point of view, what has to happen?
Well, I'm always fascinated when astute and attentive analysts look at a subject and come out in the same place through completely different paths. So when Kevin, did his summation and said, I think it's a good buying opportunity, I agree completely. I agree with Kevin. I would say the same thing, but I disagree a little bit with some of his descriptions. So if I can just drop a few footnotes. Kevin said that, talked about the peak in August 6, 2020. It was the all-time high for gold, about $2,069 US per ounce. And he said, his quote was, straight down since then. Well, if you take August 6, 2020 and October 7, 2021, down is down, no question about it. But it's not straight down. This has been one of the most fascinating roller coasters. We had 3 smashes. We had a 4% smash in, when I say smash, an air pocket. It goes down like in 24 hours, 48 hours at the most. We had a 4% smash in June 16, 2021, when the Fed first said, hey, we're going to taper. They've been dialing up the messaging since then, but that was the first time that any Fed release referred to a taper sooner than later. We had a 9% smash on August 8th, 2021, on a Sunday night when Shanghai, London, and New York physical markets were all closed. This was executed, clearly a manipulation of some sort. We don't know the culprit. I suspect the Russians, but who knows, right? Down 9%, high to low. I can't even say intraday because it was like 8 o'clock on a Sunday night. But that was again, they was executed through the futures markets, and the physical equivalent of the futures sold were 50 metric tons. And everyone on this call, and I assume most of our listeners, knows that 50 metric tons is a lot of gold for anybody. You can't buy it. I mean, call JP Morgan and say, offer me 50 metric tons, they'll hang up the phone, but you can do it in the futures market, and that's what happened. And then another smash, again, about 4% a couple of weeks ago. I don't have the exact date. It was around September 23rd, give or take. So what gold has actually been doing, it's not straight down, not even close. It is trading in a range. It's a broad range. The central tendency is $1,800 an ounce. The high end of the range is about $1,900 an ounce. The low end is $1,700 an ounce. It's a big range. That's 11% or 5.5% on either side of the central tendency. If you look at a chart, are there a couple peaks where it just kind of got over 1900? Yeah. A couple lows, 1678, where it went below 1700. Yeah, but they were all like a day or two, and then it kind of got back in that range. And so that's important because gold is actually going sideways. It's going sideways around the central tendency of $1,800 an ounce with a lot of volatility, but it's staying in that range. So gold is kind of going nowhere, which is really, really interesting to me because, by the way, I don't consider myself a technician. I consider myself a fundamental analyst and a global macro analyst, but I look at charts. I think charts are information rich. I don't pull out the whole technical bag of tricks, and I'm familiar with it. I just, it doesn't have that much value for me. But a chart does have value. It's very information rich. And so you look at the chart, what's fascinating is not, gold is down over that entire period from the peak. Yeah. But since the drawdown was mostly between August 8th, 2020 and the end of September 2020. That happened pretty quickly. And then it just got in this range I'm talking about, and up and down with a lot of volatility in the range. It's a paradox. On the one hand, you're kind of going sideways, but on the other hand, there's a lot of vol in the range. So if I'm not a day trader, I recommend gold for portfolios, and I think that's pretty well known. And I recommend a 10% allocation. That's pretty well known. But boy, if you were a day trader and you just bought the dips, you would have made a fortune in this because that pattern has persisted for really 14 months at this point. So the question, I just also want to drop a footnote on Kevin's point that he said central banks have walked away. That's not true. There might have been one quarter where central banks were net sellers. Again, I don't question the data at all. You say you're entitled to your opinion, not your own data. So Kevin's right about that. But there are far more interesting things going on in central bank gold accumulation. One of the things, I was writing an article about this, so I looked at I go to the World Gold Council. They, I don't agree with all their analysis, but they get their numbers right, and they're a pretty good source of information. And so I was looking at Russia, because Russia it was just like clockwork. They were buying, between 10 and 30 tons a month for almost 10 years. It was, they obviously had standing orders with the dealers. They don't want to disrupt the market. They were highly transparent. So, my friend Nabiolina, I call her the only central banker who actually knows what she's doing, was just like accumulate. And then China is the opposite. They've been accumulating, but completely non-transparent. I know who their agents are. I know how they do it. But then every 5 years they say, "Oh, we got 1,000 tons." Well, really, did you do that overnight, or have you been accumulating for 5 years and now you decide to tell us? Well, obviously it's the latter. But the Russians are kind of more interesting because you have a lot more information. And what the Russians did after 10 years of accumulation, they just stopped cold in around January 2021. And they didn't sell, but they just stopped buying, which is interesting. So I looked at their reserve position and I could see why, because they got gold to almost exactly 20% of their total reserves. For a round number, about 500 billion in reserves, of which 100 billion was in physical gold. So about 20%, about 2,400 tons, 2,500 tons, give or take. And they said that's enough. In other words, for the same reason I say for an individual portfolio, 10% is enough. And then people say, well, Jim, if you think gold's going higher, which I do, why not 50% or 100%? Because that never makes sense. You never want, you can be over allocated. You can be wrong also. You always have to factor that in. But they got to 20% and they just leveled off. They said, okay, we're there. And if you think about that, this is from a sovereign point of view. And this is how Putin thinks. Putin's two favorite sports are chess and jujitsu, martial arts. So kind of tells you where he's coming from. So what they did, and they did it brilliantly, they created the perfect hedge. There's no such thing, but as good as it gets, we'll put it that way. They were, by the way, they've been selling treasuries, reducing their exposure to US dollar instruments. That has more to do with sanctions and possible freezes than it does with asset allocation, but that's a factor. But they still have a large chunk of treasuries. But what do? They export oil. How is oil priced in dollars? So they've got a big dollar exposure and dollar revenues, dollar inflows, whether they like it or not, because oil is a dollar denominated market. But now they've got a big slug of gold. So one of two things is going to happen. Either the US is going to maintain the value of the dollar, and in which case gold will probably kind of continue to go sideways. You won't regret the gold, but you won't be burned on the dollar. And that'll be a nicely balanced position. But if the United States manages to get to inflation, we could probably talk more about the inflation-deflation debate. I'm like the last disinflation guy left on the planet. Everyone else is in the inflationista camp. But that aside, if you believe the US will resort to inflation, which they will eventually, we're just not there yet. This is a timing issue. Then what's going to happen to your dollar assets? They're going to be worth less. But what's going to happen to your gold? It's going to scream. It's going to go to the moon. So there they are. If the dollar is solid, they got a really nice diversified position. And if we resort to inflation, their gold's going to go up and the dollar price of oil is going to go up. So they've got a beautiful hedge. This is like a masterpiece of hedging and wealth preservation on a going forward basis, which is what a reserve position or sovereign wealth fund, as the case may be, is supposed to do. So the Russians have handled this in a masterful way. But while I'm looking at all this Russian data, something just jumped off the page. And I was like, whoa, because I hadn't, followed it, and there it was. Japan has been running at about 600 metric tons forever. I looked back like 30 years and it hadn't gone up. I suppose you could go back 40, but it was just like the 600 tons. All of a sudden, Japan's position goes up 80 tons. Like boom, like almost to 700, and in 1 month. I said, well, like the Chinese, I know you didn't buy it in 1 month. The market's liquid. It's not that liquid. You can't buy 80 tons. And then I looked into it. What they did, it was an accounting entry where they had the gold in another account, and they did the accounting and moved it over to the reserve position of the Bank of Japan. By the way, China does the same thing. They have a sovereign wealth fund, State Administration of Foreign Exchange, run by an ex-PIMCO guy. And then they had the People's Bank of China. Everyone looks at the PBOC, but which is, they have a website, but SAFE is non-transparent. So when you see these big jumps in Chinese gold, it's an accounting entry moving it from SAFE to the People's Bank of China, and then boom, but it's been in the safe literally all along. Well, Japan did the same thing. Now, I don't know where the gold came from, what side account or ledger or whatever inside the MOF, the Ministry of Finance, but they had it, and the 50-ton shows up. So then you have to ask yourself, okay, got it. Why now? Why did they decide to print? Sorry, I misspoke. I said 50. It was 80. Why did they decide to print an 80-ton increase when they had the gold all along? Why now? Well, look at Afghanistan. Look at the U.S. humiliation. Look at China on the march, flying 86, their equivalent of an F-35 over Taiwanese airspace. The AU-KUS deal, giving Australia nuclear-powered submarines. The Quad, getting India. If you're Japan, suddenly you might have to, become a nuclear power. You might have to go it on your own, go along. And if you're China, you're going to invade Taiwan. Why stop there? I mean, once you start World War III, you might as well invade Japan. So Japan felt they had to make a statement, and they did, but they did it in gold. So is Kevin right about 1/4? Sure, but the central banks have not walked away. In fact, if anything, by the way, Russia's resumed buying recently. Russia's still in the game. China's in the game in a non-transparent way. Japan has decided to hoist their gold flag. Turkey's buying gold. The other one we know they're buying, but we don't know how much. They're not transparent, is Iran. So the central bank acquisition of gold is still going very strongly. They're still in the game. I also disagree a little bit with the Bitcoin thing. I mean, I actually, as you, Ronnie, I'm sort of getting back on the live circuit. We all got used to Zoom or whatever, but I've got some live presentations coming up. So I've been.
You're going to New Orleans, right?
I'm going to New Orleans,
Yes.
right, and then I was invited to give a presentation on the cashless society, basically the future of money at Hillsdale College, and everyone, I was like, what's Hillsdale College? I said, well, it's the new Harvard. I mean, as places like Harvard and Yale have grossly lowered their academic standards, Hillsdale is where all the big brains are going. I call it the new Harvard. That's where the really smart people. So I was actually honored to receive a guest lecture invitation there. But so I've been kind of brushing up on this a little bit. But so I just do a ton of work on Bitcoin. I don't know how I got dragged into it, but it's kind of hard to avoid. Bitcoin's interesting in ways that most people don't understand. But the idea that somehow Bitcoin allocations are detracting from what would otherwise be gold allocations, yeah, maybe a little bit around the edges, but that's not a big factor relative to what central banks are doing. The truth is, I'll talk about, even though I'm in Canada, I'll talk about Americans. Americans don't get gold. We've had, don't understand gold. We've had 40 years of I wouldn't even call it miseducation. We just stopped teaching it in the 70s. I would say if you're younger than I am and you know anything about gold, you're either self-taught or you went to mining college, because we just stopped teaching it as a monetary asset. But of course it is. But so Americans don't get too excited about gold. Yeah, but Americans will buy gold when the price is, when it's gone from $5,000 an ounce to $7,000 an ounce in like 6 weeks. They'll be, I got to get some, But Kevin's right. The time to get it is right now. Kind of while you still can in some ways. So then, kind of getting back to your question after that very lengthy digression, but I just wanted to I just thought it was important to enrich the background a little bit, because the central banks are not out of the game. Bitcoin, I don't think, is a big factor, and the straight down thing is not straight down. It's down point to point, but with a very interesting pattern along the way. So when you see something that's range bound, which it is, and a central tendency, which is $1,800 an ounce, then the analytic question is, what's going to change that? Because it will change, and it'll break. It'll either break up or down. We don't know exactly when. And my expectation, I guess what impressed me is the floor. Kevin talked about 2% floor inflation. Maybe we can talk more about that, but I see it as a ceiling. But the $1,700 per ounce floor in the range is very significant, because to me it sets up what I call an asymmetric trade. An asymmetric trade is one where it might continue to go sideways, but you're probably not going to lose a lot of money and you could make a ton, no pun intended, since we're talking about gold. But the point is, if you got a floor at 1,700 and you've got upside up here, you don't know exactly when you're going to realize the upside, but if you can just stay with it and not get too upset about these periodic crashes, you're in a position where you've got what looks like a solid floor and lots of upside potential. That's a good trade. Again, I'm not a day trader, but timing matters and trends matter, and that's a good one. So then the question is, what's going to cause gold to break out of the high end of that band and get back to, 2070 an ounce and go further and then make its way to 3,000, 4,000, in sooner than later, but I'm not saying, next year, that soon. The answer is, it will be a shock. but it will probably be a shock that none of us have on our shock list. And what I mean is, we muddled through a pandemic for the last 6 months, the worst, at least from the U.S. point of view, the worst in history, because we now have more fatalities than the Spanish flu. Globally, that's not true. The Spanish flu is still number one, but we're talking about the third worst pandemic in the last 650 years. The other two being the Black Death of the mid 14th century, and then of course the Spanish flu of the early 20th century. So that's a pretty big shock. And we've had some others. We saw, we saw major developed economies basically shut down. And that's what happened in April 2020. We basically shut down the store and then, reopened by the third quarter. And most countries have not made it back to December 2019 levels of output. The United States barely clawed its way back by the end of the second quarter. But, a year and a half to get back to where you were, that's extraordinary. I mean, usually you bounce back in 3-6 months after a recession. And a lot of the world has not yet recovered that. We're still at least 5 million, I think actually more, in terms of lost jobs that have not been recovered. I know the unemployment rates now, but that's because people are moving out of the labor force. The labor force participation has dropped. So there's nothing normal about where we are. It's not the end of the world. We muddle through, we carry on, but we're never going to get back to where we were really behaviorally and psychologically. This will be a multi-decade intergenerational adaptation. But we got through that. We're making our way through it. So the pandemic shock and economic shock, political shock, if you will, and change of leadership in Germany, quite a bit going on. But none of these things has moved the gold price, other than kind of very transient moves. So what is it going to be? I guess if you use a sort of Bernoulli process, you would say it'll be something. Meaning, if you had five low probability, let's say you had 5 events, each of which had a 10% probability, but you had a 3-year time frame. So you say 10%, that's pretty low, yeah. But if you got 5 of them, that's 50. And if it's 3 years, the odds of one of them happening in 3 years is 100%. So, that's just the math. But my point being, I don't know what it will be, and I don't know exactly when, but I feel that we, again, using a Bernoulli process, I think we can say with high confidence that there'll be something of that magnitude sooner than later, meaning probably, 2022, 2023, that will shake gold out of this central tendency and shoot it significantly higher. So I agree with different analysis, but I agree with Kevin's conclusion that this looks like a good time to buy.
Can I just jump in there, Ronnie? One of the things that first of all, I completely agree with a lot of it. I wasn't trying to say that central banks aren't buying. In fact, all I was trying to do was explain why gold has disappointed over the last year. And the one kind of pushback to your point about gold's gone sideways. Yes, gold's gone sideways, but if you look at the Bloomberg Commodity Index, it's rifling to new highs. So if you were a gold holder looking, to hedge quote unquote inflation, then you've been deeply disappointed. So that would just be my kind of quick pushback to this.
First of all, Kevin, you're exactly right. Except gold is not a commodity; it's money.
Okay, and I don't disagree with you that there are at times it's different. It's the two, or even always. But I'm just saying that a lot of people bought it, expecting it, and to protect them against this coming inflation that we've seen. And if you go back to that August, time period, August 2020, when everyone was reaching for it, the bullish enthusiasm was awfully thick. And yeah, I did use a little hyperbole when I said it went straight down. I didn't mean that. But on a relative basis, it's been very disappointing since that point. And I think that central banks walking away was part of it. And I agree, they're back now. And I think that we end up at the same place. I think that they're back now. It's one of the underloved assets that nobody is picking away at. And to me, it's a buy.
Yeah, and I agree we're in the same place. I would disagree that maybe we're on to the next topic. I'll leave this to Ronnie and Mark, but I don't see any prospect of significant inflation. Now, your energy prices are skyrocketing as Canada may do okay in the U.S., but Europe and China are going to freeze in the dark. I know that's a cliche. I hate to use cliches, but this one might actually be true. Seriously, there are going to be fatalities in the UK and elsewhere with what's coming this winter. Because all the misguided so-called green policies, and turn off all your nuclear reactors, turn off all your coal plants. We actually need a little more CO2 to keep the plants alive, but Germany did what they did, and Putin is dialing down the tap, and we'll see what happens. So yeah, so natural gas prices are skyrocketing. Oil is not far behind. Absolutely correct, but that's not the same as inflation for a couple of reasons. Number one, it's not broad-based and persistent. Number two, I always say that if, sort of a son's idea, if you want to understand the enemy, you have to think the way they do, not the way you prefer. And so if you're trying to think like the Fed, which can be painful, but the Fed excludes that. They look at non-core, core, and I know most analysts laugh and go, well, you got to get groceries and gasoline, so why not look at non-core? Okay, but the Fed doesn't. They look at core PCE year over year, and when you take energy and food out, that's actually coming down very quickly. So I don't see the inflation, although of course you're right about commodity prices, and there's also a recursive function there. You take oil that high, you actually put the economy into a recession.
Okay, go ahead, Ronnie. Sorry.
Just a few minor things to add to this discussion. I think it's also what has put some pressure on the price of gold in dollar terms is obviously the strength of the dollar, or we could also say the weakness of the euro. If you have a look at the Dixie, for example, so gold in euro terms actually looks pretty interesting from my point of view. I think another point that might be on the negative side is, I think, the whole tapering discussion. I think that it's a bit similar to rate hike discussions, which normally put pressure on the price of gold, and then actually when we see the first rate hike, this has been over the last couple of years often the time when gold actually made its bottom. But perhaps talking a little bit about the commodity space. I mean, our view has always been that that gold is very, very early to discount fiscal and monetary stimulus, and we once did a presentation called the seventh sense of financial markets. So gold probably was first and discounted the developments very, very early on. In spring last year, it made its bottom way earlier than equity markets, and then for commodities it took much longer to make the bottom. Now at the moment, agricultural commodities are doing well. We're seeing base metals have done tremendously well. We saw recently, by the way, congratulations, Kevin. I know that you've been in the natural gas trade very, very early on. And obviously also the oil market going crazy. But perhaps, and I would love to pick your brains on that. Perhaps gold is already discounting that the whole inflation debate has gone too far. So I think there's not only one disinflation guy out there. There's another one. It's not only Jim Rickards, it's also Dave Rosenberg, a strategist that I highly respect and that I really read every day. But I would like to lead over to a discussion regarding the Federal Reserve. And we know that they've been, as always, quite behind the curve. But now we saw an interesting, and Kevin wrote about that, the resignation of Fed officials Eric Rosengren and Robert Kaplan. They were definitely in the more hawkish camp. So from my point of view, do you think that the whole scandal or trading controversy, does it diminish Jay Powell's prospects for being reappointed for another 4-year term? And did you also recognize this U-turn that Powell just recently made? So he made some comments recently that QE will be fully wound up by the mid part of next year, which took me quite by surprise. And the other big surprise from my point of view was that the extent of the move up in the dot plots, which is, we know that it's basically useless, but still it's telling us what the Federal Reserve is seeing. So the introduction of the 1.75% Fed funds rate as the median forecast for 2024, that's showing quite a hawkish turn, I would say. Do you think that the Federal Reserve now is really getting concerned about inflation, that perhaps they see that it's not really transitory, that it might last longer for quite a while? What do you make out of that?
So thanks, Ronnie. I guess you know me for a while. You've known that I have been quite bullish on risk assets for the past year and a half, ever since COVID. I have been kind of hammering home that the Fed and, more importantly, the fiscal authorities will do whatever it takes, and that this will be a tailwind for both for risk assets and it will provide and the economy, and we'll be shocked at how well both will do coming out of it. And that's been my theme for ever since the March kind of COVID lows. I've gotten recently very concerned and outright bearish on risk assets, and it's for two reasons. I look at, first of all, on the fiscal side, I call it fiscal fatigue. We've gotten into a point where we no longer are willing to run the big deficits. The governments aren't willing to spend. We're sitting around arguing about this latest bill, and it's, whether it's 1.5, 2.5 trillion, it's actually over a long period. And not only that, it's going to be completely, there'll be tax raises. Whether it's completely paid for or not, it doesn't really matter. The point is that 6 months ago or 9 months ago, the Democrats shoved through a bill that was like, I don't know what it was, $2 billion. That was just money spent out the door.
Trillion.
And I'm sorry?
Trillion.
Yes, trillion. Oh, did I say billion? Yeah, I guess I got to.
I have the same habit. We got to get the two.
We got to get rid of the two. We got to get rid of that. So there's $2 trillion just out the door, and we just spent it. And so now, we're sitting around and arguing about this, and I look at it and I say, okay, we shoved $2 trillion out just into people's genes, and now we're arguing about whether it's 1.5 or 2.5 trillion over 5 or 10 years that's investment. So the reality is that the fiscal side, we have fiscal fatigue. There's less money going out. The governments are spending less. Then you combine it with the fact that 9 months ago, the message from the Fed was, we're going to have flexible average inflation targeting. We're going to put up with inflation being higher for longer. We're going to, fix the problems of many years of certain minorities not having as much employment. It really seemed to be there was a whole narrative where the Fed had made this shift to a new Fed. There was a new Fed that came along. And one of the things that worries me is that I look at this most recent FOMC meeting, and it seems to me that Powell went and almost abandoned flexible average inflation targeting. And the thing about it is, I guess you could argue that we could focus on the F. It was always flexible. They never defined how much was too much inflation. And it seems to me that they've hit their uncle point. They've done the taper. The taper they announced was quicker than anyone expected. And I completely agree with you, Ronnie, that this is bad for risk assets in terms of that you'll see. And one of the reasons that I'm bullish on gold is that I think that gold will start to see through this next move. And this next move to me is lower in risk assets. We're going to see problems in the stock market. We're going to see problems in the economy. You can't simply go from putting this much stimulus in on both the monetary and fiscal side and just withdraw it and then not expect there to be changes. And so ultimately, one of the reasons that I'm bullish gold is I think that they're going to look through this and they're going to start to anticipate the next cycle. If you understand, they're going to see that we are going to get a backup. And I don't know when that is. And that's really the question. How much hawkishness from the Fed, how much withdrawal on the fiscal before things break again. But I definitely think that the way we're headed is that we're headed towards something breaking again because of the macro environment souring. It used to be these were two great tailwinds. You'd have the Fed be at your back doing flexible average inflation targeting. You'd have the fiscal spending. Both of those are headed the wrong way. And we all know that asset prices are priced not in the absolute amount of whether it's a positive or negative. It's priced at the rate of change. And to me, the rate of change on both sides are headed the wrong way. So I'm kind of expecting that we're going to see a situation where the risk assets revolt, and then eventually the Fed will have to return to their dovish ways. Like, I actually am wondering if we even get to the point where we have a rate hike. Everyone's talking about these pricing and the rate hikes. I'm not sure that we even get to the tape. If we taper, like by the time we finish tapering next summer, I'm not sure that we're even going to have a strong economy still, and that we'll be doing rate hikes.
Hey, Kevin, may I just interject this question? So in this scenario, what would interest me is, what's your view on yields? Because I think probably the classic trajectory of yields would be going higher at first until this tipping moment or whatever risk on moment kicks in, and then you will have this counter move already, Fed getting dovish and yields falling again. I mean, some of us at least have been waiting for a long time thinking about a moment. What happens if that doesn't happen? And what happens if in this incidents yields actually continue to rise? And do you expect this, or would you see this as a probability?
So I am very bearish on bonds. I think yields are headed higher. And I know that seems like a contradiction because I'm telling you that the Fed's not going to raise rates, yet I think that bonds are headed higher. First of all, just in terms of absolute levels, if we look before COVID, inflation was running well north of 2, and the 10-year was 180. Right now, we have inflation running 5%, and you can say what you want as transitory. It's still 5%, and the 10-year is 1.5. And if we think back to the Powell's moment where he said we're a long way from neutral, when he was actually the hawkish when he had first come into taken over the job, he had done that long way from neutral. Inflation was running CPI, although you shouldn't use CPI. The Fed uses PCE, but regardless, CPI was almost 3%, and we had a situation where the 10-year went up to 3.25. It was a long way. So I expect yields on the long end to rise, and I expect yields at the short end to stay pinned. So I will agree with the disinflationists that the chances of the government ever getting, or the Federal Reserve ever getting hawkish enough to invert the yield curve, or to be hawkish to the point where they're changing things, I agree. I don't think that's going to happen. I think that we're going to keep interest rates at real negative levels for a long, long time. I think it's essential. It's the way you get out of this. You need to inflate. And we can argue about whether that's going to be effective and what makes inflation. But I definitely think on the monetary side that what we're going to see is the central banks pushing back against long-term rises in yields, and they're going to be slow to raise, even though right now we're having a slight moment where we have the central banks getting a little more hawkish. The reality is, as they do that, asset prices come down, and then they revert back to this. We have to be dovish, and that's ultimately the toughest thing as a strategist is mixing timeframes. And I could sit here and talk to you about what I think about the next 3 months, 6 months. I think there's a lot of risks in the market. Having said that, over the longer run, I actually think there's more risks in the bond market than the stock market. And the reason I believe that is because I think inflation is going higher. And I think that is the ultimate end result of all of this change. And we probably should just get into it. Jim is a disinflationist, and I understand the argument, but I think that what changed during COVID was that we had a willingness of governments to run deficits. And so we've had 40 years of the governments trying to influence the economy solely through monetary means. Like if you think back to the 2000 and the 2000 when they raised rates, they didn't go and try to change the economy, slow it down by raising taxes. They did it, or by stimulating. They did it all through monetary means. So ever since Volcker, we've had 4 decades of governments tuning the economy through monetary means. And what happened was in the great financial crisis, we hit this point where all of a sudden we couldn't stimulate anymore. The reality is that we had hit the zero bound. They tried to do extraordinary measures. We all know that quantitative easing doesn't actually cause inflation. It doesn't actually do anything to the real economy. We didn't realize it then, but most people will admit that now. And what changed was in 2020, when COVID hit, we all of a sudden got a willingness to run deficits. So now all of a sudden, it's there's 2 ways that money is created. One is private sector, lend it into existence. The other way is that the government spends it. And the government spent it, and we were shocked at, a lot of people were shocked at how they filled the hole in the COVID crisis and how quickly the economy bounced. But the reality was they were running huge, huge deficits. Now, if they don't run those deficits, I completely agree with the disinflationists that the tendency is for us to go and sink back, that we need to run those deficits for them to continue to make inflation. And I guess where I disagree with the long-term disinflationists like Rickard, like Jim, and like Schilling, is that I think there's been a change in attitude. I think that we are going to see more and more willingness to elect governments that are willing to do this and to run huge deficits. And I think that eventually we're actually going to get to the point where they don't even count it as deficits. They're going to figure out a way to just spend the money into existence, whether it be through some SDR or, we're talking about the $1 trillion coin. There's been a change in attitude. There's been the younger generation has come, and they no longer feel like that this is something that needs to be, the budgets don't need to be balanced. They've adopted MMT, and you can say what you want, whether you think it's going to end badly or not. I don't bother arguing about whether it makes sense. I just argue about where are we going? What is going to be instituted? And to me, I see a wholehearted change in attitudes about government, attitudes about deficits. And that is why ultimately I think we're actually going to get the inflation that nobody thinks is going to come.
I think that was also pretty clearly confirmed by the election results in Germany recently. And I think this is really the last big haven of austerity and the frugal Swabian housewife. This is a thing of the past, and I would agree. I think that's what's reeling. It might be anecdotal evidence, but it seems that this wage price spiral is now really starting to spin. A friend of mine, he just emailed me before, and he says, well, I'm looking for an assistant, and all she has to do is she has to pretend as if she was working. She has to be there at 9:30 in the morning at the latest, but it's really hard to find people. And this is also something that I experienced in the United States. It's really people have a hard time finding good people that really want to work. But anyways, I think that's what's I agree to many things that you say, Kevin, and I like the fact that you always write about MMT, where Jim says that it's not really a theory and it's not really modern, but you say that it is basically coming, and you're fairly agnostic when it comes to it. You don't want to have philosophical discussions. It is just what's going to happen. from my point of view, first of all, this would also probably imply that there would be Brainerd would have, although at the moment I think it's 70 cents on the dollar that she's gonna be nominated, but that would probably imply that her chances are actually bigger. And then the second thing I wanted to ask you and also Jim is, in your scenario, doesn't this imply also that as soon as yields continue to rise to some point, I don't know, perhaps it's 2% for the 10 years, that a yield curve control, which is basically unlimited quantitative easing, will be introduced? And I mean, we had it already. And do you also think that this might go hand in hand with the Federal Reserve actually starting to buy equities? Wouldn't that be the next logical step, the next logical reaction in the next crisis?
Okay, so I'll go first. First of all, I think everyone focuses on the Fed, and it's because of these past 4 decades when the Fed has been the policy setter, and the setting that rate too low has encouraged commercial banks to go out and to create money. I don't think the Fed is as important as everyone thinks anymore. I think that the Fed, although it's important that they facilitate the fiscal policies that we're going to see, the expansionary fiscal policies, I don't think that they're going to be the driving force. So yes, I hear what you're saying, that who they put in there might seem important, but I actually don't think that that's as important as what the fiscal deficit looks like, what governments are choosing to spend, how their stance has become more important. To me, all the Federal Reserve can do, all any central banks can do, is mess it up, meaning pushing against it is going to cause pain. And I don't think they're going to be able to do it. So I just think that the Fed cannot create inflation. I think that if we've learned anything, that's what we should have learned, and that it is created through fiscal means mostly. Now, in terms of your question about the yield curve control, I get this one a lot, and I always think it's funny because literally, it was a year ago, I think the 10-year had gone from 75 basis to like 110 or something, and everyone's screaming about the Fed needs to step in and do yield curve control. And I'm like, are you guys insane? Like think about what you're saying. You're saying that they need to go in and peg the 10-year yield because it's gone from 75 basis points to 110. Like, that's the most ridiculous thing in the world. And I just gave you an example. In 2018, the 10-year was 3.25. So yes, maybe eventually they're going to think about doing yield curve control, but it's not going to be right now. There's going to be way more pain. They're not going to peg it with basically treasuries at their all-time high. Like, if you go look at a real return of a treasury account over the last couple of decades, it's been it looks like a .com stock. Like, it's your return has been huge. And to think that we're going to have them peg it at this level, I think it's ridiculous. I don't think it's going to happen. I think that all you have to do is look at how many people are employed on Wall Street trading bonds, and think about the lobbying that will be done from all of the JP Morgans and all of those people of the world. I think America, if there's one thing they believe in, it's free markets. I just think that they will be the last ones to do it, because let's face it, look at the Japanese bond market. It's ended. There is no Japanese bond market. It doesn't trade. Like, I think there's days that it goes through and it doesn't trade. So I don't worry about them pegging the yield curve, and especially so at these low levels.
Jim,
Yeah,
you want to jump in?
Yeah, sure. It's a lot to unpack. So a couple of things. I was taking notes just so I don't lose track of all this. On the Powell appointment, I agree. I think at this point it's going to be Lael Brainerd, and the resignations of the two regional reserve bank presidents just pulled the rug out from under Powell. complete politically. I'm talking about the economic effect. I don't think would be that great, but politically, it's a very big deal. It gives the Biden administration the cover they need to put Lael Brainerd in there. To me, the biggest single factor was not those resignations, although that's a big deal. I'm not understating it. It was when Elizabeth Warren came out and said, we can't have Powell. I forget her exact phrase. She's a threat to humanity. Something.
He's a dangerous man.
Dangerous man. Yeah, well, dangerous to Elizabeth Warren. But yeah, so I think that was the last nail in the coffin. Having said that, I don't think it matters. Lael is the only one who understands international economics. It's a real, void in the Fed. They go into the boardroom and try finding someone who understands, foreign exchange markets or international economics, or the extent to which inflation and other phenomena are moved through international markets, exchange rates and currency wars and all that. She's the only one who kind of gets that, so that's a plus. Yellen is clueless; she has no idea. So that's probably a good thing in terms of the intellectual caliber, but it really doesn't matter. And the Biden administration has shown that they'll bow to the left. This whole idea, Joe Sixpack from Scranton, Pennsylvania. I mean, it was a good campaign meme or theme or whatever you want to call it, but it's nonsense. We saw that when a small mob of activists chased a United States senator into a woman's room and filmed her while she was in the stall, closing the door, flushing the toilet, coming out of the stall, berating her. It turns out the Democrats have 50 votes in the Senate. They need all 50 plus a tiebreaker, which is Kamala Harris. She's the vice president. She's president of the Senate, the way we have it. You need all 50 votes. You can't lose one. Well, the senator they chased down into the ladies' room is one of the votes they need, Kirsten Sinema. So it's like, oh, okay, gee, you need her vote to do anything you want. You need her desperately. And your idea of persuading her is to have a mob chase her into a ladies' room and embarrass her publicly. Not such a good idea. That's just stupid. But that's what's going on. And they surrounded Joe Manchin's yacht with they call it a yacht. I mean, I don't know, it might have been a 40-foot boat or something, but they were out there in kayaks, berating him and all that stuff. So this is the kind of silliness bordering on stupidity, or I would say it is stupidity going on in the U.S. political arena. But having said that, Biden's reaction was, well, that's part of the process. Actually, it's not part of the process. Vigorous debate, a little bit of sharp elbows. That is part of the process, but not what's going on. So and when it came to the showdown between the House progressives on the 3.5 trillion, it was really a welfare bill. It's all, they call it human infrastructure. It's just a euphemism for welfare and benefits that they intend to make permanent. And then on the Senate side, Manchin, whose vote you need, Kirsten's Sinema's kind of kept her own counsel, but Manchin's like, I could get there with 2 trillion, but forget the 3.5 trillion. And Biden, through Ron Klain, as chief of staff, signaled to the House progressives, no, you guys are on the right track. Stick to your guns. Like, okay, so you're blowing up your biggest domestic policy initiative by kowtowing to progressives, and then you lose the one indispensable vote in the Senate by kowtowing to the mob. This is all in the course of 48 hours. But without kind of dwelling on the stories, what it tells you is that the White House is enthralled to the progressives. And what that tells you is that when Elizabeth Warren wants Powell gone, then Powell's probably gone. So I think that's right. Having said that, Kevin said the Fed's not as important as most people think. I agree completely, except I'll raise that by an exponent. The Fed's irrelevant. The Fed is irrelevant and impotent. Now, if you're a trader and you want to make money in the Eurodollar futures curve, yeah, pay attention. And and the kind of things Kevin was saying, I think, are exactly right. And you can make money as a day trader in Eurodollar futures. But if you're thinking in terms of macroeconomics, if you think in terms of growth, if you think in terms of what's driving the economy, what really matters, the Fed is again irrelevant and impotent. Irrelevant, they can't do anything, and impotent because it doesn't matter if they try. So and as far as the dots are concerned, Ronnie, you got that right, but it's worse than that. At least it's worse. I happen to have had some, long drawn out conversations over more than one bottle of wine with the guy who does that, the guy who writes I'm not talking about the PR department. I'm talking about the guy who frames the magic words, patience or, progress. The guy who writes that stuff, he's advised proudly sitting in the lap of Ben Bernanke, Janet Yellen, and now Jay Powell, and no doubt Will Brainerd. He's like the mafia, you try to get out and they keep bringing you back in. So this is the guy who knows more about this than anybody. And he told me, he said the dots are a joke. No one inside the Fed takes them seriously. We wish we had never started it, but we did, and now we can't get away from it. So it's good and this is from the guy who writes the dots, right? So he said to me, so yeah, it's good fodder for CNBC. It's good fodder for financial television or whatever. And then I love the way Wall Street, they take all these dots, each one of which is irrelevant and probably wrong. And then they average them to come up with some central tendency. Here's where the economy is going. That's a joke on a joke. So let's forget the dots again, unless you're kind of a day trader. So the dots don't matter. The Fed doesn't matter. But let me be more specific about why, because I don't like to make declaratory statements like that without explaining it. The answer is velocity. In other words, I try to keep the math simple. $7 trillion times zero is zero. At least where I went to school. I don't know what they teach today, but the point being, $7 trillion of M0 times zero velocity equals zero nominal GDP. If you don't have velocity, you don't have an economy. And that's the problem. They can print all the money they want. How do they print money? Well, we know how they print money. They call Goldman Sachs. They say, offer me 10-year notes. Goldman Sachs give them their price, or, treasury bills or whatever. And they say, done. And Goldman or Morgan Stanley ships the bills to the Fed, and the Fed pays them with money that comes out of thin air. That's how they create money. Okay. But what do the banks do with the money? They give it back to the Fed as excess reserves. That money is sterilized. It is not being lent. It is not being spent. People are not borrowing. Savings rates are at decade-long highs. And even when we hand out checks, do they spend some of it? Yeah. Do retail sales go up for about a month? Yeah. But actually, most of it's being saved. People are saving. This is what's called precautionary savings. We're saving for a rainy day, if you want to use the vernacular. They're not spending the money on average. Some people have a higher marginal propensity to consume, but most of it's not being spent. About 3/4 of it is being saved. So the point being, the Fed can print all the money they want. You can understand money printing as a desperate effort to keep up with the decline in velocity, because nominal GDP is this times this, right? It's money supply times velocity. Again, it's an identity. It's very simple. Well, velocity is dropping, which it has been for 10 years or 20 years, depending on which money supply. There's different velocities for different, M0, M1, M2, et cetera. Depending on your money supply, it's either been declining for 10 years or 20 years. But even taking M2, which has been going down for actually about 13 years, you look at the first quarter of 2020, and that was the worst part of the pandemic economic impact. It was a cliff dive. It went straight down. So in the last 10 years, it's gone from round numbers about 2.8 to 1.2. That's scary. I mean, you get below one. Now you're in a world where $1 of printing doesn't even produce $1 of GDP, let alone any kind of multiplier. You're actually causing GDP to go down once that number gets below one. So, and that's what's happening. So that's why there's no inflation. Okay, April, May, June, July ran a little hot. Those are 50% of that approximately were base effects. And some of it was real, but supply chain had a factor. Supply chain is easing. It has not gone away. It's still a big factor, but it is going away. The base effects have completely gone away. Watch the numbers. Over the next couple of months, you'll see them come down a lot. Best leading indicator of that, the Atlanta Fed GDP now, which is not perfect, but pretty good. It's better than anything else I've seen. If you go back to May, their second quarter forecast went from 13% to 7.5% by the end of July for the second quarter, because it was a month lag. The actual was about 6.5%. So they were kind of close, but that trend was down. Then they started the third quarter estimate around 6.5, kind of where the second quarter came out. Today it's 1.3. And I'll tell you this, you have to understand how they do that. It's not a typical Wall Street Fed forecast where you have some data and then you extrapolate and then you make up the other data based on regressions, which don't mean anything more because we're kind of living in a new world. What the Atlanta Fed does, they take the data they've got. They say, what would be the best estimate of GDP now based on what we have now without guessing as to filling in the blanks. And then that gets more and more accurate as you get further into the quarter because they fill in more of the blanks, but they don't make it up the way Wall Street does. So what that means, and here we are in mid-October, we'll have the number on October 28th for this third quarter ending September 30th. But if they started the quarter at 6.5 and they're at 1.3, that means the latest data is possibly negative because that's an average, right? So you have to have terrible results right now to take the 6.5 down to 1.3. But if you say, where are we right now? You're bordering on recession. So I'm not forecasting recession, maybe not, but those are very, very kind of scary numbers in terms of growth. It's one reason why we're not going to get any inflation. But this is stuff that a lot of analysts, and there's a lot of data out there, and everyone has their favorites. But thank you, Ronnie, for mentioning my name in the same sentence with Rosie, because I agree with you about Rosenberg. I watch him very closely, and thank you, Kevin, for mentioning me with Gary Schilling, because I know Gary pretty well, and he's my favorite beekeeper, and but he's also very I follow his work very closely. So that's what we're looking at. So just to kind of sum up, the Fed is impotent and irrelevant unless you're a dollar futures day trader because of velocity. And they can't control velocity. Velocity is a psychological factor. How do we feel? You want to go out to dinner tonight, take your friends, drinks on me. That's one state of the world. You want to stay home, watch TV, and leave your money in the bank. That's another state of the world. The second one has velocity of 0 because I didn't spend my money. So, and that's what we're up against. Now, Kevin gave a really good summary on fiscal policy, but let's talk about that for a second. So before COVID, at the end of 2019, the baseline budget deficit forecast for fiscal 2020 and fiscal 21 was $1 trillion per year, which was high. I mean, Obama was kind of at the $1 trillion level in 2009, 2010. By the end of his term, in 2016, they had got that down to around 500 billion. So, okay, nice job. Trump kind of started increasing it again, not quite the fiscal conservative people imagine. But the forecast for 2020 and 2021 from the Congressional Budget Office was 1 trillion. So your baseline is 2 trillion over the 2 years. Okay. So then Trump in June 2020 does I'll use round numbers, a $2 trillion bailout. That's when everyone got their $1,400 checks or whatever. Trump, again, in December 2020, on his last couple of days in office, does another trillion. I think it was actually 900 billion. And that was another $600 check. Okay. Biden comes in, and in February 2021, he does 2 trillion. This is the Biden bailout plan. That's another 2 trillion. So right there, 2 trillion baseline, 3 trillion for Trump, 2 trillion for Biden. You got $7 trillion. And by the way, Kevin's right. A lot of these are multi-year and some of them involve investment. Got it. But these are the numbers we're talking about. Now, since then, the Senate has voted on a $1 trillion infrastructure bill. That's more deficit spending. There's no revenue coming in other than baseline stuff. And that Nancy Pelosi is holding it hostage, so we'll see. But that'll probably get done. There's bipartisan support for that. And there's a $3.5 trillion welfare bill on the table, and that's not going to be 3.5 trillion, but it's probably going to be 2, because even Manchin said, I'll do 2. So let's call it 2, even though the bill is 3.5, and that'll get done somehow. That adds up to $10 trillion in deficit spending. What was the accumulated deficit from George Washington to Donald Trump on December 31st, 2019? The answer is 22 trillion. So you've increased the national debt you will have over a multi-year period, granted, by almost 50% in 2 years versus 22 trillion in 270 years. That's what we've done. And that's going to take the total deficit to 32 trillion. It's going to take the debt to GDP ratio to 135%. You know who's at that lunch table with you at 135%? Lebanon, Greece, and Italy. That's, you know, and Japan is they're a world of their own, but that's the only out. Japan's an outlier, but yeah, Lebanon, Greece, Italy, and the United States. Americans like to make fun of like Spain and France. Like, you guys are socialists, you spend too much money. No, France is like 90%. It's high. You know, Spain's like 100%. That's high, not 135%, which is where the U.S. is heading now. So yeah, I agree with everything Kevin said. I'll just raise it, you know, see you and raise it a level because it's actually worse than that. But here's where I disagree with Kevin. None of this is stimulus. They call it stimulus, you know, again, pick up the Wall Street Journal, watch CNBC, stimulus, stimulus, stimulus. It's not stimulus. It has no stimulative effect. It is deficit spending, does increase the debt to GDP ratio. It is real money, and it is modern monetary theory. I doubt the typical member of Congress has ever heard of modern monetary theory and can't even articulate it, although articulation is painful because it's so, I know Stephanie Kelton, she's the big brain behind this and professor at State University of New York. She is the Bernie Sanders whisperer. She was Bernie Sanders' economic advisor in the 2016 campaign. She was his economic advisor in the 2020 campaign. She's not just another egghead. Nice lady, by the way, big brain, but she's not just another egghead. She is Bernie Sanders' economic resource. Bernie Sanders is the chairman of the Senate Budget Committee. He's not just nobody. He's the gatekeeper on all fiscal spending when you have you know, a serious case of cognitive decline and senility in the White House, right? So don't underestimate Sanders' role in all this. And she's Bernie Sanders' economic brain. So that's what we're dealing with. Average member of Congress doesn't know anything I just said. They don't know it, but they're doing it. The point is, whether you know it or not, whether you can articulate it or not, whether you read her book or not, I recommend her book. Again, just to see how silly it is, you got to read her book. She says, and this is her from her book, this is not my version of it, that we don't need a bond market to fund deficits. That the existence of the bond market is a favor to investors because it gives you a place to put your money, but we don't actually need one. All you have to do is give wire instructions to the Fed for Lockheed, you know, Boeing, you know, et cetera. And the Fed can wire the money directly to Lockheed to pay for the F-22 Raptor. I mean, she says that. It's like the bond market. Why do you need to issue bonds to pay for things? Just give the Fed the wire instructions and have them send out the money. And we don't need a tax system. And Kevin said, you know, well, maybe we'll raise taxes to pay for that. That's probably right. She said, but no, we don't need a tax system to pay for things. All we have to do, again, just tell the Fed to send the money. And so why do we have a tax system? Well, she would say, well, it's to redistribute wealth, of course. You know, take it from the rich and give it to people who don't have it. And just in case there's some inflation, you might dial it down with high taxes. I get it, right, Stephanie? So we have inflation, declining growth. You think raising taxes is your cure? Well, I'll leave that to her, but that's what's going on in Washington. Now, here's why it won't work, because the research, and here I'll look to Ken Rogoff at Harvard and Carmen Reinhart. She was at the University of Maryland, who's at Harvard briefly. She's now chief economist for the World Bank. Carmen on her own with associates and Kevin and Carmen together have done a ton of research on the impact of high deficits on fiscal growth. And what they've shown, you know, developing economy, short time frames, long time frames, 100-year frames, 800-year frames, every time they look at it, they come out with the same result, which is that if there is a Keynesian multiplier, and there probably is, although query whether you're just bringing growth forward rather than actually creating net new growth. But yeah, if you're in a big enough rut, you got to climb out of it. So let's say there's such a thing as a Keynesian multiplier. It's like everything else. I would say if you want to understand economics, go to Los Alamos or ETH in Zurich. You got to talk to physicists if you want to understand economics, because they understand complex dynamic systems and phase transitions. The economists don't know much. But what it shows is that 90% debt to GDP is what the physicists would call phase transition, through the looking glass, you know, again, common language, the tipping point, you know, et cetera. I don't like that phrase, but that's what it is. Above that, so it's diminishing marginal returns to the point of 1 and then below 1, meaning at 30% debt to GDP, which is a very comfortable level if you do some more deficit spending. For every dollar spent, you borrow a dollar, spend a dollar, you might get $1.25 of GDP. But then all of a sudden it's like $1.10, then it's like $1.05. But once you go past 90, you borrow a dollar, spend a dollar, and you get like 90 cents of GDP. Well, what are you at 135? Well, you 135% debt to GDP. You might borrow a dollar, spend a dollar, and get 50 cents of GDP. In other words, you're increasing the debt. You're increasing the debt to GDP ratio. You're decreasing the Keynesian multiplier, which is already below 1. So in other words, negative growth relative to the spending. The one thing you're not getting is growth. And so Kevin's exactly right about the deficit path. And I would say that where we are in the debt to GDP ratio curve, not only is that not stimulus, what you're going to get, because people look at it, they use common sense. They're like, you know what? I always say when it comes to your own money, everyone has a PhD. People look at this and what they do is they save more. They save more. And eventually they'll get into gold and hard assets, which again, I agree with Kevin on, because it can only end one of several ways. There are only a couple of ways for this to end. One is default, like, okay, we're just not going to pay you, okay, Argentina. The US won't do that, doesn't have to do that, because we can, as long as you can print the money in the same currency as your debt, there's no reason to default. You just print the money. And MMT actually says that. So we're not going to default, okay? But there are a couple other ways out. One is inflation. And by the way, Kevin said, I'm in the disinflationary camp, which I am, but he used the phrase at one point, long term, which I'm not. So right now, yes, count me as a disinflationista, not an inflationista. That's absolutely right. But you look out, this is what we do because, if you have the right models and predictive analytics, you look out to 2023 and beyond, I would expect decades of high inflation. Decades of high inflation. But we're not there yet. We've got to get through the bottom of the chart. So I would say we're still in a disinflationary environment. You guys, all of you have said several times, real rates are going down, which is a good for gold. Actually, real rates are going up. And the reason is nominal rates have gone up, but inflation is going down. So the real rate's going up. Now, Kevin said something I thought was the most important thing on this call, and I agree completely. He just said, you got to have negative yields to get out of this. And Kevin is exactly right. You need negative yields. But let's talk about negative yields. In 1980, I took my first mortgage buying a condo in New York. Actually, it was a car in New York. And my mortgage was 13%. And I told my mother, and she cried because her first mortgage was 2%, in the 1950s. And I said, and Mom said, why are you paying 13%? I said, Mom, I'm paying 13%, but inflation is 15%. And I was living in New York where the taxes at the time were 50%, 50, and the mortgage interest was tax deductible. So my real after-tax cost of borrowing was -8. Because my 13 was really 6.5. 13 was like 6.5 because I had a 50% tax rate, and then two more for inflation because inflation was 15 and rates were 13. So my real rate was -8.5. That's a negative real rate. That's kind of rate that gets people rocking and rolling. But real rates, first of all, right now are positive because again, when you start talking about real rates, it's obviously it's nominal yield minus inflation, but there are 50 different versions of yields and inflation. So I think you have to be specific. I look at the 10-year Treasury note yield to maturity, and most people don't. I use it because I think it's a good proxy for a long-term investment. But if you're looking at LIBOR or Fed funds or something, you get a different result. I'll grant that. But I use the 10-year yield to maturity on the 10-year Treasury note compared to PCE core year over year. And if you take those numbers, real rates are slightly negative, but they're going up fast because inflation will be dropping very quickly. And as far as Kevin's a bond bear and he's got a lot of company. I'm a bond bull. when I say bond, I'm talking about government bonds and, benchmark notes, in particular, 10-year Treasury note, or, the equivalent in the bonds or JGBs, et cetera. But on the 10-year Treasury note, I'm a bull. Rates have backed up to 1.5%. Yeah. But on March 30th, they were 1.745. So in my view, it's a backup in a downward trend. And I would look for that yield to maturity to be down around 1.2 or lower by the middle of next year, and maybe even go into 90 basis points. And by the way, Kevin said something else that is like absolutely mark it down, because I agree completely. See, the Fed's going to taper in November. All the data is pushing the other way. The Atlanta Fed data, GP I just mentioned, would be a good reason to hit pound the brakes. But the Fed, first of all, is always wrong. You have to pay close attention to the Fed, because it's a great forecasting tool, because they're always wrong. They don't turn easily. They do not move quickly. So when they set themselves on a path, it's like it's like they're throwing a ball. It's going to go a while before it changes course. They're going to stay on that path. Now, do they change? Yeah, but it takes 6 or 7 months of data and 6 or 7 months of debate to get the Fed to change. One of the greatest blunders in history was the tightening from 2015. They raised the Fed funds rate. There was the famous liftoff. They waited a year to do it again because they didn't want to be embarrassed in 2016. But by 2018, Yellen and Powell together had got it up to, I think, about 2.25, 2.5, maybe 2.25, whatever that range. What happened? From October 1st, from October 1st, 2018 to December 24th, 2018, the stock market fell 20%. That bottomed out of the Christmas Eve massacre. And then Jay Powell got religion, gave a speech in the week between Christmas and New Year's when nobody was working, and said, time out, we're gonna look at lowering rates, and he did. But that's what happened the last time they tried raising rates. They sent the stock market down 20% in 3 months. 3 months. So
and actually, gold was one of the very, very few assets doing well in that quarter.
Correct. And so that's going to happen. They are going to start to taper in November. They are going to be on a fast track taper. And again, Kevin's right. My estimate would have been a year, but no, Jay Powell said June. So, okay, June 2022, there you are. And then the Fed's actually highly predictably wrong, but predictable in terms of their action. So they will, when they do this, it's watching the movie in reverse. Like, how do they do it when a panic hits? Well, first they cut rates to 0, and then they start QE. I think we're up to QE 6 at this point, and then they sort of slow down. Then they but then they do it backwards. So what's backwards? Tapering, undoing the QE, which is now QT, quantitative tightening. And don't listen to the analysts who say, well, they're not actually tightening because they're still printing. No, again, Kevin's right. Everything happens at the margin. If you print less, that's tightening. Yeah, you're still printing, but as long as you start printing less, you're tightening. Then they get all the way back to 0, meaning they're not buying or selling securities on that. And then, and only then, will they start to talk about raising rates and like, what's the gap? But Kevin's right. By the time we get to the middle of 2022 and the taper's over, if I'm right about the data and the trends and disinflation, et cetera, they may say, hold on, we can't raise rates. And by the way, that happened because the first taper was over in November 2014. And when did they raise rates? December 2015. That took 14 months to do a liftoff that they weren't even sure they would do. By the way, that was the bottom for gold. Gold was 1050 on the 2 days before the liftoff. Gold was 1050 2 days before the liftoff. So in 2015. So I would look for the taper to play itself out, but I would say by the middle of next year, even the Fed will realize that they blundered again, and that there will be no liftoff anytime soon after that. And then, no, they can't cut rates. I don't think they're going to go negative, but I agree with Kevin. They may not have a rate hike. Well, in my view, certainly not in mid-2022, and maybe not ever, because things will be pretty bad. Maybe, we're looking at things, Ronnie, that may not happen in my lifetime. There's no way out. There is no way out of what they've done except inflation, but they've forgotten how to cause inflation. I would say it's a sad day when a central bank wants inflation and can't get it. That means they don't know how to do their jobs. The Fed could get 10% inflation in 15 minutes, but they won't do it. I talk about this in chapter 6 in the conclusion of my last book, The New Great Depression. They can do it in 15 minutes by saying the price of gold is now $5,000 an ounce. The vaults are open at Fort Knox. We're a seller at 40.50 and or 49.50 and a buyer at 50.50. And if you think it's high, come on in, we'll buy from you. And if you think it's low, the doors are open at Fort Knox, you can have some. But if you do that, then the price of gold is $5,000. You're basically a market maker with a bid and an offer. And if you have enough gold and enough printing press, you can do it. And they do. So, but they won't do that. They won't do what I just said because they've institutionally forgotten that's how the system works. The two people who did do it, one intentionally, one unintentionally. FDR did it intentionally, worked brilliantly in the middle of the Great Depression. Nixon did it by accident, but it also worked, and that's when gold went up 2,700% in 8 years.
But by the way, that's a great book that I just finished reading. It's called 3 Days at Camp David. It's a fabulous book. Jim, thank you very much. Just a very, very quick last round. What do you see opportunities in the fourth quarter? Kevin, perhaps starting with you from a risk reward perspective, where do you see the nicest or the most attractive setup in markets at the moment?
Well, I'm a hedge fund trader and I can trade from the short side. So to me, I look at it and I look at how top heavy the US stock market is. If you go look at the top 8 stocks, you'll see that they are 25% of the capitalization of the S&P 500. We have not been at this level of concentration since the 1950s, since the Nifty 50 or the 60s, I guess, for the Nifty 50. And I look at this and it just screams to me, danger, danger, danger. If you look at ever since the COVID lows, the S&P 500 is up almost 100%. The top 8 stocks, those top 8 stocks that I mentioned, they're up 150%. Even more scary is the fact that if you look at the Goldman Sachs non-profitable tech index, it's up 250% since those lows. So I see this, and to me, what's happened is we've had a huge concentration, a huge amount of betting, just institutional investors crowding into this trade. It was an easy trade to do with the stay-at-home, the change in technology, the fact that rates went lower, which let's face it, tech stocks are the longest duration asset out there. They're the most sensitive to interest rates. And it's setting up to me to the point where, Scott McNally from Sun Microsystems has this famous speech when he looks back at the dot-com bubble, and he talks about the fact that Sun Microsystems at the time was trading at 10 times sales. And he says, what were you guys thinking? For me to make money, I would have to have no cost of capital. I'd have to have no employees. I'd have to have nothing. And then I'd give you all the money, all the revenue for the next 10 years. And he was just kind of astounded. Well, I did a little bit of work and I pulled up the top 8 stocks and I looked at their like how much they're trading versus sales. They're trading at 12 times sales right now. And I get it. Listen, I understand completely that those top 8 stocks are juggernauts that make lots of money, and it's much different than the .com. I'm not disputing that one bit. I am disputing about how crowded that trade is. And not only that, when I think about an allocation of, you look at a long-term investor or pension fund or endowment over the past, let's say, decade, 2 decades, if you weren't overweight US stocks, you lost your job. Because the reality is that, apart from the Nikkei, which did okay, most world stock markets over a long period have been very marginal, like 2%, even in local terms and in US dollar terms. So if you were a European pension fund manager, the reality is that you've been buying US stocks because they've been the only game in town. I happen to believe it's because the US has been more willing to run fiscal deficits, but that's a story for another day. But anyways, long and short of it is I look at it, and to me, the short side of the US stock market, and specifically those top 8 stocks, and even better would be the non-profitable tech stocks, are setting up for a great short. I look at it, and one thing to think about is if you look and plot the regression of ARK, which is the Cathie Wood vehicle, the ETF, if you plot that against the Goldman Sachs non-profitable tech index, it's almost a 99% correlation. So I'm short that. I think that's a great trade. I think that that's going to be something that catches people off guard. And from the long side, I love inflation break-evens. Like that's, we haven't talked about that, but there's a way, if you wanted to be exposed to inflation, there's a way of doing it. It's by buying tips and shorting nominal bonds. And you can expose yourself to the market, the embedded future kind of inflation about the market, what they're pricing in. To me, I'm on the other side of Jim's camp. Although I guess we disagree about the timing. I think it's here, and I think it's come, and that we're going to see, apart from the next 3 to 6 months where we might have a little bit of a hiccup, over the long run, I think that inflation's headed a lot higher, and that this is one way to protect yourself. And then finally, another way to do it is gold. I think that it's been a down and out hated kind of commodity. One thing to think about is that in this environment, we're going to have a situation where a lot of these gold miners will be one of the few things that investors have a tax loss on. Almost everything, a lot of other things are up. So for me, I'm getting out my shopping list, and I'm looking to buy some gold miners into the tax loss selling season.
Kevin, I think you'd like our current portfolio because we've implemented exactly these 3 trades. So long break even, long gold miner, and some short spreads on the Nasdaq.
Do you have room for me, like in Liechtenstein?
Yeah, but unfortunately, we discriminate against US investors. So it's probably
Kevin's Canadian. Come on.
You Canadians are welcome. So that's no factor here, fat guy. Great, thanks for that. Ronnie, I think we've had a great call. I think we should wrap up. Jim, I think, had already basically told us his conviction trade. I'd say, so if I understood that correctly, long bonds. You're keeping to your guns for the time being, right?
Yeah, but I agree with Kevin on the stock market. Shorting an index is always dangerous. I was thinking, an 18-wheeler can be heading for the cliff, but if you try to say, hey, slow down, you'll get run over. So be careful shorting the index. But I agree with Kevin. I think the way Kevin described it, pick your spots. If you want to, by the way, and he mentioned a few indicators, but there are a lot of others, and Kevin knows all of them. But the Shiller Cape ratio, the Buffett, valuation to GDP ratio, there are 10 different indicators, and they all say the same thing. This stock market is way overvalued. If you were looking for a sector where maybe you could make some money on the long side, even though the whole market is overpriced, I would look at the defense sector. Everyone's like, Biden's anti-defense and humiliating. Withdrawal from Afghanistan, all true, but the same was said about Carter in '79, and we had a defense boom under Reagan. So sometimes when the U.S. is down on the mat, the bounce back can be very large. So looking at companies like Lockheed, Raytheon, Kratos, Leidos, which is an intelligent company, Palantir, they could have a good run, even though the market as a whole is overvalued. I agree with Kevin completely on that.
And by the way, Palantir just bought physical gold as a hedge against black swans.
There you go. Well, they're in the predictive analytic business, so maybe that tells you something. And just quickly, we say bonds. Of course, in the U.S. we distinguish between bonds and notes, but I like the 10-year Treasury note. Kevin and I are on at least short term. We're on different sides of that trade, but longer term, I think we both. I'll speak for myself. I see a lot of inflation, but not for another year or two. Keep your allocation to gold. What I tell people about gold is, it may take a huge price jump to get people to buy it, but don't underestimate the scarcity factor. There'll always be a liquid market, but you actually may not be able to get it from dealers when you most want it.
I think that's a great point. I'd like to say that I've been saying for a while, we are going to have $1,000 up week in gold at some point. And I really believe that it'll be like first day it'll be $400, the next day it'll be 300, then it'll have a down 100 day, and then it'll be another 400. And one of my theses of all these things is that we're seeing more and more of these rolling bubbles. And I've talked about that before, how you get a situation where investors all crowd into one thing very quickly, you know, uranium, nat gas, meme stocks, Bitcoin. We see these rolling bubbles, and I still think that gold will have its day. It will have a time in the limelight with the rolling bubble, and it will have $1,000 up week.
Yep, I agree completely.
Thanks, gentlemen. Awesome, shameless advertisement for your services. Have a look and buy Jim's books. I've got them in my bookshelf, of course. Have a look at his newsletter. I told Kevin before off record that actually the Macro Tourist newsletter is way too cheap because you're super productive, but it's really fantastic. It's great value. It's always fun to read. You've got great pictures. You've got very thought-provoking ideas. So thank you very much for putting that out. And thank you for taking the time. I wish you two gentlemen and Mark, of course, a great day. Thanks for taking the time, and all the best in the fourth quarter, and looking forward to seeing you in person, hopefully at some point later on. Thank you very much.
Great. Thanks for having me on. It's a pleasure meeting all of you. Take care.
Appreciate it. Thanks.
Thanks,
care,
Jim.
everybody.
Thanks, Kevin.
Thanks.
Bye, Mark. Thanks. Bye-bye.